Okay, we're going to go ahead and get started. Thank you for coming out and joining us today. We're going to talk about the one thing that nobody wants to talk about, but everybody probably should talk about because it is the biggest determining factor between making and losing money. We're going to talk about the psychology and the emotions involved in trading. Anyway, my name is Carley Garner. If you have any questions or comments or concerns about anything that you see today, you can contact me here. There's my email address, my phone number. If you're on social media, you can check us out at Twitter, Facebook, and Instagram. Just search for DeCarley Trading and we should pop right up. I am a broker, a strategist, an author, and I even wear a couple of other hats. It's a small business. That's how things go in small business. I do write a column for Stocks and Commodities magazine. It's called Futures for You. I also contribute content to Jim Cramer's Mad Money, mostly technical analysis in the commodity markets, such as gold, crude oil, even the S&P and the NASDAQ futures, that sort of thing. And I write a couple of newsletters for our brokerage clients. We are a brokerage house. I should make that clear. We offer futures and options trading on either a broker-assisted level or even discount online trading. So we offer service levels across the spectrum. We are brokers. If you're a client of ours, you would receive our newsletters, the Financial Futures Report and the DeCarley Perspective, which does include market commentary, trading ideas, those sorts of things. If you're interested in downloading our mobile app, you can find it on either the Apple App Store or Google Play. And with the mobile app, you'll have access to streaming commodity news feeds, both video and text. And if you're a client of ours, or if you sign up for a trial, you'll also receive our internal information, so our trading newsletters, our trading ideas, commentary, that sort of thing. The app is free to download, by the way. And again, if you're a client of ours, all of the information is available for free as well. I've written a handful of books. I've written some of these multiple times, but the two that I recommend are the two larger ones at the top, Higher Probability Commodity Trading and A Trader's First Book on Commodities. If you're a beginner, A Trader's First Book on Commodities is the best place to start. If you're past all the basics, such as how to calculate profit and loss, what the trading symbols are, that sort of stuff, you may want to skip on to Higher Probability Commodity Trading. In that book, we talk about market analysis, putting a strategy together, that sort of thing. And before we start, I want to make sure that everybody's well aware that we are trading, it's not investing, it's risky, it's not for everybody. A lot of money can be made or lost. Okay, if you walk away from anything from today's class, I want you to understand that speculating is easy, but trading is not. And these are two completely different things. Most people assume they're the same thing. They are not. In my opinion, trading is 95% emotional management. One of my favorite quotes is the following: "The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading." And we all know, fortunately, most people that trade commodities lose money. And there's a lot of various array of factors that cause that. There's free leverage, and most people have a hard time hedging their leverage properly or managing their leverage properly. There's also the tendency to overtrade, all kinds of emotional fallacies that we'll talk about today. But the reality is most people that attempt to trade commodities do lose. It's not easy. And this includes people that are extremely book smart. I find that some people are almost too smart for their own good. Being too smart sometimes will hurt you in the markets because a lot of people come out of their finance background and they expect that there's some sort of magical equation or mathematical problem that they can solve, and it'll tell them what a market is going to do next, and that's absolutely just not how it works. Markets are based on emotion, which is what we're talking about today. And the reason that is people or things that are moving the markets are us. We're buying and selling. And sometimes we're doing it for no good reason or no fundamental reason. Sometimes we're doing it because we're scared or we're greedy or both of the above. I've seen over and over and over how emotions can impact trading. You could give two traders the exact same entry and exit signals, and it's very common that they would experience different results. It might be because of panic liquidation. It might be because of the inability to respect position sizing. Might be various views on the markets and strategy and that sort of thing. But the reality is if you told two people to buy here and two people to sell here, they're probably not going to have the exact same trading results. And the difference is how they manage their emotions and how they deal with the stress. Emotion might be the most influential factor in trader success or failure. Inability to keep fear and greed at bay can quickly lead to financial and psychological devastation. Trust me, I've seen I've seen it all. I've seen the good, the bad, and the very ugly. And again, most of the damage that people inflict on themselves and their trading account comes from an emotional standpoint, not necessarily that they had a bad strategy, although that happens as well. But if you think about most of the decisions you make to buy or sell a particular future or option or whatever the case is, regardless of whether you did your homework or not, and hopefully you did, some of that is probably being influenced by emotion. You may not even realize it, but it's there. It's always there. Another thing I'd like to point out is paper trading is only minimally useful. I talk to people that paper trade for years and some even decades, and they assume that the skills that they learned in their paper trading account are going to carry over to live trading, and I want to say never does. I'll say almost never does to be safe, but I've never seen anybody mimic the success they have in a paper trading account a live account. I've met some people that have bragged and bragged and bragged about how much money they were making and how well they were doing with their trading, and then when I point blank asked them about the funding and the situation of their account, they admitted it was a paper trading account. I actually had one particular person who had been paper trading for the long run for years. I'm trying to remember, I think he started with like a $100,000 fake monopoly money paper trading account, and he brought it up to close to $1 million, and he was really excited about it, and he ended up getting a big drawdown in his paper trading account. He actually cried, and so I had to clarify, are we still talking about a paper trading account? And he said yes. So if you are paper trading for years and you experience a drawdown and you cry over your paper trading account, I would venture to say that commodity trading is probably not for you. Okay, so paper traders sometimes predict market price changes with surprising accuracy, and market spectators often make big long-term projections that prove to be true, and this is because there's no pressure on. It's just like playing sports. When you're in spring training, the Chicago Cubs, they were kicking butt in spring training, and as soon as the real season hits, it's a little different ballgame, and a lot of that is because of the emotional pressures that come with playing for fun and playing for real. But being a market spectator or a paper trader has absolutely nothing to do with profitable trading. It's an illusion because it eliminates the emotional experience on the ebb and flow of the market price and the potential reaction of the trader. I've had people come up to me and tell me that they think crude oil is going down, and then 3 months later they'll come back up to me and they'll say, see, I was right. I could have made a lot of money. I should have taken my own advice. But what is being ignored here is what happened between now and 3 months ago when he originally said crude oil was going down, because it could have very well been that crude oil rallied $10 before it drops 20, and most of the time when people come up to me with those long projections and talk to me how right they were, that's usually the case. They usually were eventually right. The odds of them putting a trade on and suffering the drawdown on being there for the correct part of the trade are probably pretty slim. So there's a big difference between being right and making money. Even traders that accurately predict a bull or bear move with trades implemented and the intention of profiting from their insight might lose money. For example, option buyers might be hurt by time value. I just talked to somebody today who purchased a natural gas put earlier in the year, and natural gas, sure enough, is lower than where it was when he purchased the put, but he's still losing money, and that's because of the time value of that option has eroded. That option becomes less valuable as time goes on, so he learned that lesson. Option sellers are sometimes forced out due to volatility. Early on in somebody's option selling experience, they believe that if the futures price never reaches the strike price of their short option, that there's somehow no way they can lose money, and that is absolutely not the case. I've seen more people lose money on options that were never even close to being in the money than I've seen people lose on options that went in the money. And I know that's hard to fathom, but it happens because when volatility explodes, it's the deep out of the money options that explode on a higher percentage basis. So futures traders are often stopped out or forced out due to margin deficit before the market goes their way. Or some people are all talk and no action. They never actually enter the market, they just talk about it. So all of these things are reasons why people that accurately predict market movements may not actually make money. It's really difficult to do. And again, there's a difference between trading profitably and speculating, two different things. So one word of advice is to prepare and even expect for anguish. Paul Tudor Jones once said, "Every day I assume every position I have is wrong." And I think there's some valid points into looking at the markets like this. If you're constantly assuming that your position's wrong, you're probably going to be a little more willing or eager to protect yourselves, to hedge yourself, to make sure you're not being complacent. Because complacency does kill. It does. It kills a trading account. And we're all guilty of it. We're human. We all have the same tendencies. But the idea is we want to recognize those and hopefully combat them. The bottom line is if you can't take the heat, get out of the kitchen. Trading is a mental game of both wits and stability. And I'm not talking about being smart. I've known a lot of very, very, very smart people that have a hard time in the markets. And I know a lot of people that have a hard time with day-to-day tasks that do well in the market. So it's not the same kind of intelligence or ability, and to be quite frank, not everybody is equipped with it. It's similar to the medical profession in which only certain types of people are equipped to handle the sight of blood. Not everybody's capable of absorbing the stresses of trading. And markets are mean. If you trade long enough, the market will make you cry. And I am not kidding. I really mean sobbing, crying. I don't know if any of you are familiar with optionsellers.com. They were a CTA that managed money for people for a very long time. They were option sellers, obviously, because you can see by the name. They were around for a long time. They were well known. They were well respected, and they happen to have short natural gas calls and short crude oil puts without really any hedges in late 2018. And if you pull up a chart, you'll know exactly how that ended. It didn't end well. In fact, the accounts that they were managing for people, not only did they lose all the money in the accounts, but they lost more than they had in those accounts. So those clients ended up owing money to the brokerage, and that's never fun. And of course, the trader or owner, whatever you want to call him, is infamous for creating a YouTube video in which he cried. And I felt this pain. Before entering the market, traders should assess the major areas of support and resistance, determine where stops might be placed, look at the option premiums, etc., and use this information to determine a hypothetical worst case scenario. I say hypothetical because ultimately we never know what the worst case scenario is, because we can't tell the future, and sometimes what we think is the worst case ends up being almost the best case. So you just can't underestimate this stuff. But if you go through and you analyze things, you can kind of get an idea of what you think might be the worst case. And if the thought of that makes your stomach churn, this trade is not for you. You don't want to put yourself in a situation that causes undue stress, because that leads to poor decision making and it triggers destructive behavior. A lot of people, when they're suffering a loss or they're frustrated from a loss that they've realized, they start revenge trading, they put on too many contracts, they lack patience, they're forcing things, and that it never ends well. So the secret is, don't put yourself in that position in the first place. So let's talk about recognizing fear and greed in the marketplace. So you can recognize when fear is taking over your personal trading account or the market itself. Fear basically prevents traders from entering a market based on a chosen strategy. They have a signal, but they're too scared to get in. Or it encourages traders to liquidate prematurely in an attempt to cut losses. Their strategy told them to go long, but it didn't start off so well. And even though their strategy hasn't told them to get out, they may decide they no longer want to be in the trade and they liquidate prematurely. This is probably one of the worst things you could do, because when you developed your strategy, you probably put a lot of time and effort in to discover what are the best odds of probabilities, so on and so forth. And so if you're second guessing your strategy, then you're probably doing yourself a disservice. Fear also entices traders to chase markets, following a missed signal. If you miss a trade, trust me, I've been there, I do it all the time. There's been trades I've stalked for a month and a half, 2 months, and then when it comes down to it, I say, well, I'm going to give it one more day, and then I miss it. And it hurts, and it's annoying, but the worst thing you could do is chase it. I've never seen anybody make money chasing markets. Fear also breeds irrational behavior and a deviation from strategy. So if you find yourself falling into that pattern, walk away. The reality is you have to be in it to win it. This is a chart of the E-mini S&P, well, at the end of 2008, particularly around the Christmas sell-off. If anyone was following the markets, you know very well that the stock market, I don't want to say crashed, but it sold off sharply during the Christmas time. In fact, the Christmas Eve session was the biggest slide on Christmas Eve, I believe, ever. The reality is, though, you have to be in it to win it. If you were caught up in that mess, or stopped out at the lows, or you panic liquidated at the lows, you really could have done some tremendous damage to your investment account or your futures trading account, whichever it is. Just 2 days later, the S&P was 150 points higher. That's a $7,500 move. It's really hard to recover from that. Obviously, there's no guarantee the market's going to snap back like that. Sometimes it doesn't, but more often than not, when you see that kind of crazy liquidation and panic in the marketplace, the market almost always reverts back, because most of the people that were selling in December were people that were selling based on emotions, not facts or fundamentals or anything logical. More often than not, if you can adjust your position, hedge it, give yourself a chance to recover. I'm not saying hold a naked position and just let the market blow up your trading account, but instead of just pulling the plug altogether, more often than not, you're better off adjusting the trade, lessening your risk, bettering your hedge, but giving yourself a chance to be there if the market rebounds, because most of the time it does. No one has ever made a dime panicking, said Jim Cramer at one particular point. In fact, I've heard him say that many times. And I think he's absolutely right. In fact, I think I'll take it a step further and say panicking actually almost, it doesn't guarantee you're going to lose, but it really increases the odds of you losing money. Panicking is the worst thing you can do, even though that's exactly what we want to do when things get rough. So you can recognize greed in the marketplace or even in yourself by the following characteristics. Greed encourages traders to become complacent in winning trades and fail to take profits when they present themselves. Greedy traders are always looking for an extra couple of dollars, and more often than not, that's what gets them into trouble. Greed lures sideline traders into an unruly and volatile environment at irrational prices because they're FOMOing, their fear of missing outing. They think they're missing out on something big and they want to be a part of it. I think that's exactly what's happening in the NASDAQ and the stock market today. We came from the depths of despair in December, and now suddenly we've come all the way back to almost, not quite, but almost the September highs, and I feel like a lot of money was left on the sidelines, liquidated at poor prices, and those people are putting money back to work because they're scared to miss out on the next big move. Unfortunately for them, they probably liquidated at the lows in December, and there's probably a good chance that a lot of them will buy the highs. That's how markets work. I hate it. I hate that that's how it works, but that's how it works most of the time. Warren Buffett once said that unfortunately, the hangover might be proportional to the binge. This kind of gives you an idea of how sometimes greed in the marketplace takes over, but once that greed comes to a bit of an inflection point, it gets really ugly for anybody that's caught in its wrath. So crude oil last year spent 10 months rallying about $23 or $23,000 per contract. At the time of the highs in October, there were more people long crude oil futures than we've ever seen in the history of crude oil futures. Now, could the market have continued higher? Sure. However, if you notice at the top of that market formation, it went parabolic for a couple of days. And when you see that sort of thing, when everybody's long and the market goes parabolic, it's usually marking the beginning of the end. I mean, it's easy to look after the fact now and say, oh, well, obviously. But during the move itself, everybody was just convinced that crude was going to $100 a barrel. Obviously, it did not. But you want to be careful when everybody thinks the market's going the same way and everybody is positioned in the same direction, is when you should recognize the market is being greedy. When the market's being greedy, bad things happen. Afterwards, after the peak, it took crude oil 2 months to fall $32, which is $32,000 per contract. A big chunk of that, the last from basically November through December, a lot of that was hedge fund blowups. The one that I mentioned to you before was part of that. There were others. And so people were selling not because they wanted to sell crude oil or they thought crude oil was going lower. They were selling because they just were out of money, they were out of margin, or they just couldn't take the pain anymore. Okay, so now we know that emotions, well, we've always known this, but we were reminded that emotions can be detrimental to our trading. So let's look at some things we could do to mitigate the emotions using patience and savvy risk management. The best way to contain emotions is to avoid situations that cause spikes in fear and greed. This can be done via patience and avoiding overtrading. It's really easy for me to read this on a slide and to tell you about it, but in reality, this is harder to do than most people assume it is. But it can also be done by using unconventional forms of risk management, for example, using long puts and calls, not stop loss orders to manage risk of loss. So if you're a futures trader, we believe that stop losses are probably more of a hindrance than a help, and we're going to talk about that soon. If you're a short option trader, I highly recommend always hedging with long options, even though most of the time you're not going to need that insurance, but when you do need it, you're going to be extremely grateful. Avoiding stress and keeping a clear head is the best way to avoid the aftermath of the emotions. Patiently waiting for proper trading signals and avoiding unfounded trades minimizes the odds of stress. Also, I talk to a lot of traders that get bored and they start playing around and they're just scalping or day trading, and they think that they're doing it in a playful manner and they think they don't care about the money, but deep down, trust me, you eventually will care. Small losses add up and they trigger emotional decision making. So never mess around in the markets. If you want to do that, pull up your paper trading account and play around, but don't trade your real money just looking for some entertainment. That's never going to work. I recommend considering the use of options to hedge risk. Stop losses are intended to manage risk, but I argue that they probably cause more harm than good in many cases. Premature stop outs are extremely stressful and they often trigger revenge trading, but buying calls and puts to manage the tail risk provides lasting power and minimizes emotion. So almost any book that you pick up on day trading is going to tell you always use stop orders, and I get it because you don't want to go get a cup of coffee and come back to complete devastation in your trading account. At the same time, stops are generally hit at the worst times. I've seen over and over and over, traders are frequently stopped out at market highs and lows, and it causes them the maximum amount of pain. These stop outs trigger counterproductive emotions, and it leads to poor decision making. So I think there's a better way, which is using long options. There's actually two ways to do that. We'll talk about that soon. But first, let's talk about the advantages of stop losses. So if I'm telling you stops are bad, why does everyone use them? Well, the reality is they want to reduce the risk of a runaway trade. They want to feel like they can go to, like I said, get coffee without coming back to devastation or a bloody trading screen. And it happens. I did that just last weekend. We had a hog trade on or a cattle trade on. I can't remember which one. We'll take your pick. Both markets have been pretty volatile. And everything was calm and quiet. As I was sitting here, I decided to go get a cup of coffee, and I came back and the market was locked limit. So you just never know. So having a stop in there is generally a good idea. People like to know what the absolute risk is. Of course, stops aren't perfect. There's slippage and so on and so forth. But the idea is they have a general idea of what their risk will be if they place a stop order. And the nice thing about a stop order is it mitigates the emotional duress that's caused by pulling the plug on a trade that's gone bad. So the alternative to having a stop is to not have a stop, right? If you don't have a stop, you don't have to worry about getting stopped out prematurely. You can give the market room to breathe, and that's probably going to work out for you more often than it doesn't. But it just takes that one time. Maybe it's a presidential tweet, maybe it's something going on in Europe, who knows, that sends the market in a tailspin, and you happen to be in the wrong place at the wrong time. That will be almost impossible to recover from. So stops do serve their purpose. You're darned if you do or darned if you don't. The disadvantage of the stop loss, there's really only one, but it's a really big one. It's the finite nature of the trade exit. Once a trade is stopped out, it's impossible to recover, even if the market does, and it usually does. Most people find they are stopped out at the worst time. Getting back into the market after being stopped out is generally a bad idea because people do it based on emotions. If they get stopped out of a market, they try to get back in. What happens is they place their next stop too tight or maybe too wide or whatever the case is, and they end up losing on that trade also, and then it just kind of cascades into a big ball of messy trade and a lot of money lost. So again, the problem with involuntary liquidation at the hands of a stop order is the impossibility of recovery. Once a trader is on the sidelines, it's impossible to mend a trading account from a poorly timed exit. We showed that to you in the S&P. Somebody that was stopped out or panic liquidated on Christmas Eve of December of 2018 probably took a long time to recover from that because they most likely didn't. If they were stopped out at the lows, they most likely missed out on most of, or if not all of, the swing back rally. So one thing we're gonna talk about today is using options instead of stops to provide lasting power, and this can be done with swing trades, day trades, or even short option trades. So I just want to point out the benefit of lasting power. Imagine this is the Brexit vote a couple of years ago. I want to say summer of 2016. The Thursday night before the Brexit crash or sell-off, the S&P actually rallied. I want to say off the top of my head, I think it was up 15, 20 points, somewhere in there, immediately collapsed. So I can't even fathom how many people had were short the market, and they were right, but they probably got stopped out with a loss before the market dropped. So they had to watch the market come cascading lower with them on the sidelines. And just imagine trying to chase that market lower. It would have been a mess. You can see at one point in here, right in here, let me see, that's a 30-point rally. You can see it kind of bottomed here and then rallied up here and then went back down. So if you were stopped out and you did try to chase it lower, there's a good chance you got shuffled in and out for 20, 30, 40 handle loss here and there, maybe even 2 or 3 times. So again, chasing markets is really, really tough. Weekly options are great day trading tools, and not just day trading. Weekly options can be used to hedge short option trades or swing trades. Even if you're only looking to hang on to the trade for 2 or 3 days, weekly options are a great, great way to hedge them. So in recent years, the CME Group has launched a suite of weekly ES options, that's E-mini S&P, but they've also launched weekly options on crude oil, grains, currencies, metals. These options can be really useful for traders that are looking to hedge existing positions. So again, if you're long a futures contract or if you're short puts, whatever the case is, you can look to the weekly options to find cheap insurance. And you may only need that insurance for a week, you might need it for 2 weeks, you might only need it for 2 days. But the great thing about these weekly options is they expire frequently, so you can customize it to fit your needs. Before the weekly options, there were only options that expired every month. And in that situation, you would have to pay a lot of money for time that you don't need, or you'd have to use a strike price that's well out of the money, so it's not giving you as much of a hedge. So in other words, you couldn't pinpoint your hedge as well as you can now using the weekly options. So weekly options can be used in 2 ways, actually. One, as a replacement for stop loss, which is basically to insure against runaway losses in a futures position or a short option. 2, they can be used to speculate themselves. So for example, if you think the S&P is going to sell off in the next week, you might buy an option that expires next Monday or maybe next Wednesday, a put option that would take advantage of that. Because that expiration date is so close in time, you're probably not going to have to spend a lot of money on that. So instead of buying an option that expires in 30 days, you can buy one that expires in 1 or 2 days and pinpoint your speculation. So the practice of buying a futures contract and then buying a put, or selling a futures contract and then buying a call, it's known as a synthetic. And basically the idea of this is, instead of placing a stop loss, we are purchasing a call or put to protect the risk. So you're not trading naked, you're not trading with unlimited risk, you're just doing it in a different manner. You're not using a stop, you're using an option. The advantages of that are you have unlimited profit potential, you have limited risk, you have the ability to adjust. So for example, if the market goes your way, you can take a profit on your future and hold on to your insurance, hoping the market rebounds, and you can make some money off that as well. That doesn't happen often, but it could happen. And you can recycle your insurance. You can use it for other trades. So if you're somebody that trades in and out of the market several times a week, what you could do at the beginning of the week is just, for your first short trade, pick a call option that you're comfortable with, using as your risk management tool. You purchase that call. Once you're out of your futures trade, you can just leave your long call there and use it for the next short future as a hedge. So you don't have to constantly get in and out of the options. You can kind of play around with it, so it's really, really nimble and flexible. On the flip side, if you're using options instead of stop loss orders, you have to be careful, because you don't want to spend too much money on the insurance. Insurance is expensive, just like car insurance or life insurance. It's expensive, it's not free. So your futures contract will have to overcome the premium that you paid before you're even profitable. So that's something to think about. Also, short-dated options erode fast, and it lowers your delta. It basically slows things down. So if you sell a futures contract and buy a call option, your risk is limited. You don't have to worry about premature stop outs, but if the market drops, you're going to make money slower than you would have if you just had a short futures and placed a stop order. So that's the downside. Like we mentioned before, you have to be in it to win it. So if you are stopped out and you're on the sidelines, it does no good for the market to go in your favor. If you have an option hedge rather than a stop loss, the market can go against you initially, and you have the lasting power to hang on and ride the trade through, and hopefully if it goes in the direction you intended it to go, you'll be there to enjoy it. All right, let's look at a few examples. So a futures day trader might have looked at this chart and might have thought that they were interested in going long a futures contract on trendline support, but they didn't want to have unlimited risk, or at least they didn't want to have risk below 2,800. So a couple things they could do. They could place a stop loss order at 2,800. The market right now, based on this hypothetical trade, is about 2,820. So we're talking about a 20-point risk of placing a stop. That's $1,000. But if the market quickly ramps down, stops them out, and then reverses and rallies, they're completely out of the trade. So their risk was limited to 1,000, but they locked in their 1,000 and they're done, and there's no way to recover. The same trader might have decided to purchase a put option instead. Again, this is hypothetical, but these were based on realistic prices when we took this chart or put this chart together. A trader could have bought a 2,800 put expiring in 3 days for about 10 points. That 10 points is roughly $500. Remember, each point's worth $50, so that's $500. So the total risk on the trade would have been approximately $1,500, which is the 20 points between 2,820 and 2,800, plus you have to account for what you paid for the insurance. So if the market crashed to zero, let's say the S&P goes to 2,000 or 666, which is what it was in March of 2009, you're only going to lose your $1,500, but you're still in the trade. The market can and possibly, you never know, could reverse, and if it moves back above your entry price, you actually make money. Even though you were dead wrong on the timing, you could still make a little money. If that risk is a little too steep for you, the $1,500 risk, you could consider doing something a little different. Again, this strategy, or using options to hedge, is extremely flexible. It's an art, not a science. There's no right or wrong way to do it, as long as you have some sort of risk cap in place that you're comfortable with. That's really the only rule. If it's something you're comfortable with, then go with it. So this trader on the exact same setup might have decided he's not willing to risk $1,500. Instead, he only wants to risk 10 points or $500. That's probably, if you're day trading, that's probably a little more conducive to what you're trying to do. So this trader purchases an at-the-money option that expires tomorrow. So the other slide, we were purchasing an option that expired in 3 days. This option expires tomorrow. So this is for a quick day trade. We pay $500 for the option. That's the most we could lose. No matter what happens, no matter how far the S&P crashes, we can only lose $500, but our upside profit potential is unlimited. So that's another way to play it. Just let me give you an idea of how big of a difference lasting power can make. A trader that took this signal and placed a stop order at 2,800 would have been stopped out right here. It's possible that trader might have gotten back in, but it's really hard to do that. He very well could have watched the market wash out, bounce up, maybe he got in here, maybe he got back out here, and then watched the market move without him. So not only did this trader lose roughly 20 points or $1,000, he might have lost that $1,000 a couple of times trying to get back in and getting washed out and all those sorts of things. Somebody that hedged with an option would have probably maybe kicked the trash can or something, or swore, because obviously they were wrong. The market broke through support. They were wrong on their speculation, but they're still in the trade. So regardless of how far down the S&P goes initially against them, they're still in the trade. Their put is protecting their risk. They still have no more risk on the table other than what they had calculated to begin with. But look, the market turns around and goes their way. So I'm not saying this trader would have held on all the way to the top, but this is a $3,500 move. So a trader using a stop order would have been out on the sidelines with a $1,000 loss. Somebody using an option probably had a pretty good chance to at least break even, or maybe even catch a nice run. Okay, let's talk about a few mental tips to calm trading. And Again, this is one of those things that it's a lot easier to talk about than it is to do, especially when things are going against us and things are uncomfortable in our trading accounts and that sort of thing. Thomas Jefferson once said, "Nothing gives one person so much advantage over another as to remain always cool and unruffled under all circumstances." I cannot tell you how true this statement is in the world of trading. This is everything in trading. Most people that have the ability to stay calm, cool, and collected, no matter what's happening around them, were born with it, or at least the majority of it. But it can be partially learned through experience and partially through the environment that the trader has created. So let's talk about creating that ideal environment. Before sitting down to analyze the markets, you really need to clear your head. Take a few moments to relax, clear your thoughts, forget about anything that's stressful in your life, take a few deep breaths. If you're unable to get to a relaxed and rational state of mind, you should not be making trading decisions. Maybe consider lightening up on your positions or maybe even liquidating positions, and refrain from executing new trades. This is something that sounds simple and maybe even silly, but it's very critical. You cannot possibly make trading decisions if you've got kids screaming in the background or your dog chewing on your favorite shoe. You really have to make sure that you're putting yourself in an environment that's calm and conducive to making good decisions. One tip that I've learned over the years is to concentrate on looking at numbers, not money. Losing the money you've worked hard for can be a very emotional experience. You can mitigate the impact of human nature by looking at prices, not values. And this is on a per contract basis. So for example, if you're trading soybeans and you're looking at an option you sold for 10 cents and now it's worth 15 cents, simply keep it as simple as that. I'm losing 5 cents on the option. If you're trading 20, 30, 40 lots, you may not want to do the math because you probably don't want to, it's a lot easier to look at something and say I'm losing 5 cents than to look at something and say I'm losing 20 grand or whatever the case is. So looking at it from, and when you're putting the trade together also, obviously make sure you know that your risk and reward is not in dollars, but in points. And so that way it doesn't, I'm not saying be oblivious to the damage you're doing into your account or to your risk reward and that sort of thing. I'm just saying when you're analyzing things in your position, keep it on a one lot basis. Just look at points, not money. It keeps some of the emotion out of it. Be confident. Confidence gives traders the courage to pull the trigger and works to prevent panic should the market fail to immediately behave as planned. Talking to other industry insiders, other brokers, traders, educators, things like that, one thing that I've come to grips with is a lot of people when they're they have a losing trade on or they're in a drawdown, they get frustrated and they freeze and they stop performing their strategy. So the next signal that comes along, they bypass it. And then the next one comes along and they bypass it because they're trying to manage this trade that's gone bad. But in most situations, that's the worst thing you could do because your strategy in theory, or most strategies, are built on the idea of probabilities, and if a certain setup arises, the probability of that setup being profitable is probably good. Otherwise, that wouldn't be your strategy. Also, if you are executing multiple signals in multiple markets, you probably have a little bit of diversification going on in your account. So just because one trade's going bad doesn't mean all the next signals that you get are going to be bad also. In fact, maybe you'll get a handful of winners that offset some of that big loser. So just because things are going bad in one trade doesn't mean you should pull the plug on everything else. It's kind of similar to a basketball player or a baseball player. The only way to get out of a slump is to keep shooting and to keep swinging. We talked about this a little before, but I just want to make sure you understand. Paper trading really is a waste of time because it ignores emotions. The next best thing is working with lower risk contracts, such as e-micro futures. There are currently e-micro futures in the gold and currencies. The CME is soon going to be listing an e-micro futures in the S&P, which is going to be great. Actually, they're listing it in the NASDAQ, S&P, Dow, and Russell. So there's going to be micro stock index futures contracts. I believe they start trading on May 7th, and it's going to be great because it's going to give people the ability to have a stepping stone. So rather than paper trading with no emotions, you can take one step further. There will be money on the line, but it's not going to be a dramatic amount of money. You're probably not going to ruin your life trading e-micros because you can only make or lose $5 per point in the S&P, but it will give you a sense of the emotions involved and the trading and the markets and the leverage and all that kind of stuff. I also like the grains, the mini grains, and the mini currencies for this purpose also. They're smaller contracts, the margins are low, the risk is relatively low. So you can practice trading without a lot of skin in the game, but at least you have some skin in the game. And pay attention to your health. Sound mind and body are a package deal. According to the Mayo Clinic, physical activity stimulates various brain chemicals that may leave you feeling happier and more relaxed. Other studies suggest regular exercise, fruits, veggies, and whole grains promote healthy sleeping habits, self-esteem, stress relief, and improve learning capabilities. I know everybody's shaking their head reading this slide, but the reality is it does help. It makes a difference. Also, don't cheat. Do your homework. Don't put too much faith into quote-unquote gurus' ideas or subscriptions you're subscribing to, newsletters, signal providers, anything like that. We're all human. We're all trying to beat the markets, and everyone is vulnerable to the reality of being wrong. Experience is an advantage, but it's not a guarantee by any means. Each trading idea should be based on your own or confirmed by your own ideas. So again, even if you're getting your ideas from somebody else, make sure you pull up a chart, read maybe an article or two, or at least read that person's description of why they think a particular trade might be a good idea. Don't blindly follow anybody, because everybody's human. Everybody's potentially going to be wrong from time to time. And if you're blindly following somebody else's trading idea, what could very easily happen is you're probably going to be prone to premature liquidation because it wasn't your trade, it was someone else's trade. So either you're going to be uncomfortable with it when it goes wrong, and you're going to liquidate at horrible prices, or you might even do the opposite. You might become too complacent because you have too much trust in that person, and the trade might get out of hand beyond what your risk tolerance would normally be. Trade less and don't be afraid to take time off. Trading multiple contracts multiplies the stress, especially if you're just starting out. Start with a one lot, start with a mini or a micro. You don't have to trade 10 contracts. You don't have to trade 2 contracts. You can trade 1. There's nothing wrong with that. A lot of people communicate to me that they think that that's a waste of time. Trading 1 contract is a waste of time. But the reality is it only takes $50 in profits per day, each trading day, not even per day, but each trading day to equate to $12,000 in profits per year. So this makes it sound really easy. Obviously, it's not that easy, but you don't have to trade 10 contracts to make 50 bucks in a day. In fact, you don't even have to trade a full-size contract. You could do a mini or a micro. Also, this is obvious, but most people need a reminder. If you're angry or overwhelmed or depressed, stop trading. Or obsessed. I say obsessed because the worst thing you could do is stare at a screen and watch the market tick up or down, especially if it's going against you. No matter how hard you stare at the screen, it's not going to change what's going on in the marketplace. So either you need to take action and adjust your trade, or get out, or walk away. Staring at the screen is only going to exaggerate any emotions that you're feeling, and again, it can end well. So anything that we're trying to do, obviously, in speculating is we're trying to play the odds, but we have to understand the reality. We have to accept the fact that we're going to be wrong, and we're going to be wrong often. We have to come to grips with the reality that putting the odds in your favor isn't always enough. The market's going to do what it's going to do regardless of seasonal tendencies, fundamentals, technical analysis, or what we believe it should do. And realizing this will help to mitigate the mental impact of losses on current and future trades. You cannot control the market, but you can control how you react to it, and that's the key. So in conclusion, the only magic in trading is humility. There is no holy grail. There's no magic technical indicator or no trading system that always works, but being humble goes a long way. Don't assume you know what the market's going to do. Even the best traders struggle to keep their win-loss ratio above 50%. Now this is kind of an arbitrary figure I threw out there because it depends on your trading strategy. If you're a trend trader, you probably struggle to keep your win-loss above 30%. If you're an option seller, your win-loss is probably 90%, but it's those small percentage of losers that have the ability to create big losses in your account. And never say never. There's no limitation to an irrational market. We are currently experiencing this and learning this for the millionth time in coffee. So you can never say never. Just because something has never done a particular thing before doesn't mean that it can't do it today. So I want to thank all of you for coming out. I hope that you got something from it. I hope you learned something. If you have any questions, feel free to contact us. You can visit our website, DeCarleyTrading.com. There is plenty of information on the site, articles, videos. It's all free, and it's all hopefully educational or intended to be. If you're interested in learning more, I highly recommend Higher Probability Commodity Trading. It can be found at any major book outlet, but of course it's cheapest on Amazon and free shipping. You can't beat that. Here's my contact information, so if there's anything I can do for you, just let us know.